Welcome to today's Explainer. We are standing right on the absolute edge of what could be, honestly, one of the most critical days for the U.S. economy in recent history. The date is June 17th, 2026, and it is Kevin Warsh's very first Federal Reserve meeting as chairman. Wall Street is totally on edge, investors are glued to their screens, and the entire financial world is basically holding its collective breath. Today, we're going to break down exactly what is happening behind closed doors, why the market is so deeply terrified right now, and most importantly, what this all means for your portfolio. But here is the crazy part, the unexpected twist, really. According to the CME FedWatch tool, the market has already priced in a massive 97.4% probability that absolutely zero rate changes are going to happen at today's meeting. That's right, it's a near certainty that the federal funds rate is staying exactly where it is. No cuts, no hikes today. Okay, let's dive into this. If we already know with 97.4% certainty that the rate isn't budging today, why is Wall Street hanging on to every single syllable Kevin Warsh is about to say? Well, if the action today is literally nothing, the terror is entirely about what happens tomorrow, next month, and into the end of 2026. To really understand the tension in the air, we first have to understand the master strategy Warsh was actually supposed to execute. Section 4. Warsh's Hidden Master Plan. When Kevin Warsh walked into this new role, he didn't just bring some standard Fed playbook. He brought a highly complex, sophisticated blueprint to navigate the massive United States debt problem. You see, the new administration wanted growth and lower rates, but the U.S. is currently just saddled with this monumental debt burden. Warsh's plan was designed to solve both of these problems without triggering a full-blown financial crisis. It was essentially meant to be a stealthy economic engine.
Here are the 3 precise steps of that master plan, as laid out by financial analysts. Step 1. Lower short-term interest rates to make borrowing cheaper, loosening up the economy to fuel growth. Step 2. At the very same time, shrink the Fed's balance sheet by selling off long-term bonds, which intentionally drives long-term rates up. And Step 3, this is absolutely crucial, deregulate the commercial banks, specifically regarding a rule called the SLR. The whole goal here was a beautifully designed machine to print money and absorb debt without looking inflationary to the public.
Let's quickly translate that Wall Street jargon into plain English, because knowing this actually gives you a massive edge. SLR stands for Supplemental Leverage Ratio. It's a really strict rule put in place after the 2008 financial crisis. Basically, it forces banks to hold a specific amount of safety capital against everything they own, even if what they own are U.S. Treasury bonds, which are, widely considered the safest assets in the world.
And this brilliantly illustrates how the engine was supposed to work. Imagine a bank only has 100 slots for its investments. Under current SLR rules, even super safe treasuries take up those precious slots. So the banks have hit a regulatory brick wall. They want to buy more U.S. debt, but the rules basically say, sorry, we're totally full. Warsh's plan? Loosen the SLR. By doing this, banks could borrow money at those newly lowered short-term rates, use massive leverage to just gorge on long-term U.S. treasuries and pocket the difference. Their commercial banks would quietly absorb the national debt so the Fed wouldn't have to get its hands dirty.
Section 8, the geopolitical wrench. It was a seriously sophisticated plan, right? A true economic blueprint. But, as any trusted financial advisor will tell you, markets absolutely never exist in a vacuum. A massive, totally unexpected geopolitical wrench got thrown directly into the gears, and it completely derailed this trajectory.
Let's just trace the timeline that brought us to today's panic. In April 2026, conflicts in the Middle East escalated sharply. By May, this resulted in the outright closure of the Strait of Hormuz. Now, this isn't just any waterway. It controls roughly 20% of the world's entire oil supply. And as we hit June 2026, that sudden chokehold on global energy caused oil prices to absolutely spike. When oil goes up, the cost of literally everything goes up. Sudden inflation was sparked, and as a direct result, short-term interest rates had to surge back up to fight it. So compare what Warsh desperately needed to make his plan work versus the harsh reality he actually inherited today. His ideal blueprint relied on a steep yield curve. He needed short-term rates low and long-term rates high so banks could make a massive profit on that spread. But because of the sudden oil shock, short-term rates shot right back up. The curve went totally flat. The profit margin for the banks completely vanished. So guess what? They entirely stopped buying treasuries. The whole machine just stopped.
Now, what's really interesting here is this specific number, 0.4%. The spread between 2-year and 10-year treasuries has collapsed to just 0.4%. For this master plan to work in a healthy environment, that spread needs to be well over 1%. At 0.4%, banks are looking at the risk of tying up their capital for years to make practically nothing, and they are flatly refusing to participate. The incentive is completely broken.
Which brings us to the ticking time bombs putting immense, undeniable strain on Warsh today. The U.S. Treasury literally must refinance an astounding $8 trillion in bonds within the next 12 months. They desperately need buyers, but the banks are sidelined. Meanwhile, the U.S. Strategic Petroleum Reserve, which has been cushioning the blow of this oil shock, is projected to run dry in less than 80 days. Without a geopolitical resolution to reopen those shipping lanes, oil is going to spike further, inflation will surge, and a 2026 rate hike becomes a very real, terrifying possibility for the market.
Section 13, the two paths forward. So Kevin Warsh is essentially trapped. He is walking into today's press conference inheriting a remarkably formidable challenge. But as investors, we need to know what happens next, right? He really only has two distinct ways he can navigate his speech today, and the market is going to dissect every single syllable to figure out which path we're on.
So the crucial point is explicitly mapping out these if-then scenarios. The first path is the hawkish path. If he focuses heavily on persistent inflation and strong jobs data, signaling that rates just have to stay high, the market will brace for tighter conditions. The spread stays flat, and you can absolutely expect stocks, crypto, and gold to take a hit. But then there's the dovish path. If he subtly hints that the Fed will step in to support the bond market and that rate cuts are still on the table later this year, the market immediately reads that as incoming liquidity. The money printer is warming up, folks, and risk assets, along with gold, will likely surge. Section 15. Actionable signals to watch. Look, abstract Fed speak can be incredibly frustrating to decode, but it doesn't have to be. We want to empower you with exactly what you need to listen for today. You don't need a Wall Street degree, you just need to know the real-time triggers that will dictate how you should protect and position your own portfolio. Let's walk through this line by line so you know exactly how to decode the meeting. If Warsh drops the word transitory or anything like it, he's suggesting the war-driven inflation is strictly temporary. That's highly dovish. Expect markets to go up. If he mentions stress in the Treasury market or hints at Fed intervention, that means quantitative easing is likely incoming to save those bonds. Expect gold and crypto to rally hard. Finally, actually scratch listening to the words for a second. Watch the DXY, the US dollar index, right after he speaks. If the dollar strengthens, the market is interpreting tighter conditions ahead, which means near-term pain for stocks. As we wrap up this explainer, I really want to leave you with a massive, big-picture thought from our source material regarding the 15 to 20-year supercycle. History shows us that wealth continuously rotates in massive cycles between paper assets like stocks and hard real assets like gold and commodities. Driven by current debt levels, sticky inflation, and shifting global trade, many analysts believe the current supercycle for real assets is incredibly young. Whether Warsh manages to carefully navigate the paper market today or not, the broader horizon of wealth generation is already shifting. The big question is, are you positioned for the next decade or just the next press conference? Keep learning, keep watching those signals, and I'll catch you in the next explainer.